Greetings, this is Ivan Aligne, and thank you for joining me on Deep Economic Thoughts. Today I am coming to you from Hong Kong, our AWAIM HK Limited office here, SFC Type 9 licensed company. And just a few weeks ago, I was in our Los Angeles headquarters in Century City and made my way around the country speaking to many of our investors, our clients, and sharing quite a bit of what we're doing, how we're allocating portfolios, but most specifically where we see risks on a forward-looking basis. And some of this I talked about at the beginning of this year with AI and also margin debt across brokerage accounts in the US, and also the opportunity in non-US equities, as well as opportunities in other asset classes like commodities, which we have more recently increased our exposure earlier this year into commodities, specifically gold and other basket of commodities, including oil and a myriad other commodity items. So as I sit here today, on May 21st, 2026, NVIDIA just gave their earnings report for their first quarter of their 2027 fiscal year. And it is interestingly enough, not being well received by the investing public. It's actually trading off in after-hours trading in the US. And when you think of this, your first reaction is, wow, they've been growing revenues and growing earnings by significant double digits for a little while now. You would think that the investing public would be very happy and satisfied. Well, I think it's quite the opposite. I think the idea is that people are beginning to understand a company so big, $5 trillion valuation, to keep growing at the rate that they're growing becomes more challenged. That seems to be the general consensus and why it's trading off a little bit. But my perception is really focused on their dividend and the buyback. And typically, if you're a company, a high growth company, you're actually not buying back your shares, and you're certainly not paying out dividends. It's actually the antithesis of what investors expect you to be doing, which is every available dollar that you do have at the company to be investing in your growth and leaning into that growth. And so, especially when you think of all of the fundraising going on in the AI hyperscaler space and various surrounding companies around that space, so much funding. And yet NVIDIA is choosing to give a pretty decent chunk of money back to investors in the form of a cash, of an actual dividend, and also buyback of shares. So this is, I would say, probably the more disturbing part of that growth story. And what would possess a management team of an aggressive growing company to return money to shareholders? It befuddles me. I can't understand it. I mean, if you're Coca-Cola, I understand it. And Coca-Cola investors expect to get a dividend. And many other firms and companies in the world pay dividends, and this is a major attraction for investors, and they buy those companies because those are stable earnings and established brands, and people use dividend income as part of the amalgam of how they put together an income stream for their portfolio. Various ways you can do that. Dividend income is a good one. So I did find it very, very curious that Nvidia made that decision, and something that certainly raises a red flag. We already have a huge underweight to Nvidia and really the AI trade in general relative to the S&P 500 as an example, where less than 50% of the allocation of the S&P 500 to the IT sector, sitting at around 14-15% allocation to IT globally, because we do buy global equities. But we do have an absolute underweight to our U.S. equities segment in the portfolio at this time. So it is a very low exposure, and even furthermore, because of our exposure through an equal weight of the S&P 500, that exposure is even more contained. So we're already of the opinion that any day now, maybe any week now, maybe any month now, who knows for sure, but it is more, there's more downside risk than there is upside opportunity, especially when you step back and look at global equity markets, global capital markets in general, including fixed income. There are many other places to get returns for a portfolio that are not so highly concentrated and highly dependent on one very specific euphoric narrative playing out to perfection. And as asset managers that have a global mandate in global equities and global fixed income and commodities and cash, we don't have those constraints. And so we can tactically move around across these asset classes and certainly want great returns for our investors, but we are not willing to sacrifice the portfolios to the whims of the market and the whims of sentiment and changing sentiment. And that's certainly what we view with this AI trade. And, and you think of all these upcoming IPOs, whether it's SpaceX, Anthropic, OpenAI, these billions upon billions of dollars of IPOs, one IPO bigger than the other. You'd also kind of think back to the dot-com era and how this, really became a bit of a phenomenon itself. And all of these companies racing to IPO so that all the venture capitalists who invested in this thing at very early stages have an exit. And they can take the money and run. Meanwhile, the retail investor typically gets saddled with this kind of investment, and the investment banking mechanism in the marketplace is absolutely incentivized to maintain that hype and that euphoria so that there is tremendous retail demand and even institutional demand. And unfortunately, the underlying conflict is there, which is early investors want out. And the best mechanism to do that is an IPO. The least sophisticated investors in the global markets are retail investors. And history has a funny way of if not repeating, rhyming. This has happened before. We've seen this happen before. The dot-com, I think, being the most apropos example of big hype by the Wall Street investment banking distribution channel machine. And, this is not to say it's a monolith. There are some very smart and reasonable people within that capital raising function that are being a little bit more judicious in their commentary around the euphoria and the hype. But on the whole, these IPOs are going to make many investment banks a lot of money. And they've already been making a ton of money. And nothing wrong with that, of course. But it's done at a time in the cycle when the getting is good. And it's a nice time to take the off-ramp, especially if you're getting multi-trillion-dollar valuations. And so you don't have to worry so much about maintaining such significant double-digit growth in your earnings and in your revenue. And frankly, you don't really care if you're walking away with several $billion in your pocket. There's no question, in my opinion, that AI as a technology is an absolutely transformative technology in the same way that the internet was, in the same way that electricity was, in the same way that railroads were. And at the same time, those industries had significant hype and significant growth in a very short period of time, and then had significant collapse after the euphoria dissipated, and people kind of understood that, oh, this thing is important and it's great and it's wonderful, but it's really just a utility. It's really just infrastructure. And that is, there's a value to infrastructure, but it's what you do with, as an example, what you do, it's the factory that's powered by electricity that is creating the impact value in society and in economies. It's the AI that's powering the business to become more productive, to solve problems more efficiently in a more profitable way. And right now we see AI mostly showing up in, and by the way, we're using this a lot in our own firm. We're using a lot of different AIs. We're speaking to a lot of different AI developers specializing in our particular industry, trialing different things. And, we don't see that this AI is a panacea. We don't see that it's solving every single problem we have. And as a matter of fact, there's still quite a number of hallucinations and quite a lot of data that is dated and not necessarily so contemporaneous. And so there's a lot of work that you got to do with it in order to get the stuff that you need out of it. So the human capital component is still really, really important, but it's absolutely a tool to be leveraged by intelligent human capital resources at firms. So it's not a replacement for people at this point, in my opinion. We're not there yet. It's a nice supplement. It's a nice support for routine tasks, creating emails, doing some research, this kind of thing. But I think we're quite a while away before AI powering robots that are working in all the factories around the world. I think that is a very, very important consideration. So with that, I will leave you. And of course, if you have any questions at all, don't hesitate to reach out at info@alignwealthllc.com. That's INFO at alignwealthllc.com. ALIGNE wealthllc.com. Until next time, thank you.